Well, thank you all for being here this morning. We are going to dive straight into this very meaty subject. I have asked both Oren and Bryan to speak for about 10 minutes, laying out their case, then a couple of responses, and then I shall ask a few questions, and then we'll get into all the many audience questions that I'm sure will be generated from this discussion. So, Oren, I'd like to start off with you. Can you explain your policy on free trade?
Well, thank you for having me, Ovik. Really appreciate you putting this together, and I think this is an incredibly important discussion. I guess I think I'm here to speak on behalf of free trade, but it depends on what we mean by free and what we mean by trade. And it's actually convenient that we have these two terms because I think they speak meaningfully to two quite distinct arguments we hear about the case for free trade. So the free I take to be the more libertarian case, which is that freedom is good and we want people to be free to exchange things with each other. Whereas trade I think of as much more the economist's case, which is that people exchanging things with each other leads to mutual benefit and growth and all of the other things we like. And so I should say I like freedom. I think people should be free to exchange things with one another. And I like trade. I think that when we trade things, we can make both people better off. We can generate growth and so forth. My concern is that what we have in the international economy today is neither free nor trade. And to start with the free piece, I think it's one of the things I found most interesting about the freedom conservatism statement, of course, is that it endorses only free trade with free peoples, which is a very interesting and in some respects question-begging assertion, both with respect to what counts as free people and second, what exactly we should do when we don't have free people as the counterparties. But for my purpose, I would like to take this largely to mean China. And as the 800-pound gorilla in the international trading system, certainly from the US perspective, I think that's a fair place to focus. And I think the really interesting question when it comes to economic relationships with China is whether or not they are free. We say, well, if we impose barriers, we are therefore preventing the person in the US from making an exchange they might want with the person in China, and putting aside that that's for the most part, a quite foolish abstraction, and in fact, almost never is a person in the US simply reaching out to their fellow human in China and attempting to exchange things. The bigger problem, of course, is that even the most radical libertarian, I think, recognizes that to have free exchange, you actually need to take into account things such as externalities. So freedom to exchange does not mean I have the right to pollute the river. And so we have a very interesting problem. We say, well, you American, we all agree, don't necessarily have a right to pollute the river, or if you want to, you should pay some sort of bizarrely negotiated Coasian fee that we're somehow going to discover. That's fine. But the person in China lives under a different legal regime. So what does it mean to exchange something with someone in China when that person is also generating externalities, and yet because we have no control over their legal regime, we in fact know that they are not paying for the externalities. At the extreme, what does it mean when we know that in fact China has a system of forced labor and in some cases outright slavery that might be producing the good? And so I would say that to support the freedom of exchange cannot possibly extend even the most radical libertarian vision to actually supporting unfettered exchange with people or firms operating in the People's Republic of China under the control of the Chinese Communist Party. And I think while you can find the sort of narrow worst abuse as the edge case, I'm actually much more interested in the general case. And what I mean by that is if I were to posit that, yes, we want a free market, and I were to say, well, the way I'm going to set up this free market is I'm going to have two legal regimes. So I'm going to take my market, I'm going to draw a line down the middle, and one half is going to be a capitalist democracy, and the other half I'm going to give control over to an authoritarian communist regime where they can regulate and subsidize and oppress however they want. And that is my free market. I think we would say that is a ludicrous way to set up a free market. You have not created a free market. In fact, a market with no such line down the middle and two systems would obviously be the freer one. And yet, if that is our preference, the only way to achieve it is to, in fact, bound the US market and impose barriers with respect to China. So that's the free piece, and I would say that the free and free trade implies, in fact, not permitting trade with China. The trade piece, I think, is equally important, and this is where the economist's case, I think, falls apart in practice, because it's very interesting to go back, beginning with Adam Smith and The Wealth of Nations, and note that the case that he makes for trade, in fact, states extraordinarily explicitly what he is talking about is the exchange of things that others can make more efficiently for some part of the product of our own market. John Stuart Mill says it even more explicitly. He says what we are talking about in reality is the trucking of one commodity for another. And I have no problem believing that with the exception of edge cases, if we have something we can make efficiently here, and some other country has something they can make more efficiently there, and they trade that product for our product, that we can make both sides better off. That is not how trade works today. And the way you can tell is because the US runs a $1 trillion trade deficit, which means that roughly $1 trillion of goods being traded into the US market are not being traded for things that we make here and send back. They're being traded in return for US assets. So we send back treasury debt, we send back corporate debt and equities, we send back real estate. And it's important to emphasize that there is no actual basis in economic theory for saying that, for instance, comparative advantage applies to that situation. There's no basis necessarily for believing that is actually in the long-term interests of the country participating in that kind of exchange, which is not, in fact, trade as it has been defined and defended over time. So I think if we can get to a situation where, first, we are not trading with oppressed countries under different legal systems that look nothing like a free market, and second, we are ensuring that the trade that we have is balanced and of goods for goods, services for services, others make things for us, we make things for others, then I think that would be terrific. And I think it would be absolutely in the interest of blue-collar Americans and all Americans. But the system that we have today is not. And so the last piece I want to focus on is always, as a good panelist focusing on the title of the panel, what we mean by blue-collar Americans. Who are we talking about? Why does it matter to specify that? Why aren't we just talking about all Americans? And blue collar is obviously a somewhat subjective and politicized turn of phrase. What I take it to mean is, by and large, production and non-supervisory workers, to use the Labor Department's definition, and their families and communities that they support. And I think that the reason that is an important definition, and not just a politically useful one, is that the experience of those folks in the labor market looks very different from the experience of, for instance, most of us in this room. And the reason that that's the case is because they are, generally speaking, doing work that is relatively undifferentiated from each other. That is, from the employer's perspective, one worker is fairly substitutable for another. And as a result, they are fairly undifferentiated from foreign producers of the same. And what that means is that they are subject to competitive pressures in the labor market very different from what your typical think tank wonk or economist might experience. And the problem with the type of trade, or not really trade, I guess we'll call it not really free, not really trade, that we have been pursuing is that those are the folks that we have told, well, actually in a free market, you are supposed to, compete and somehow be preferable to oppressed, even enslaved labor in some other country. That doesn't work out very well for them. Now, they may see somewhat lower prices, but it turns out that low prices aren't all that matter to anybody. And while there are a number of things that we take for granted in the very narrow upper segment of the labor market about what we can have confidence will happen in our own lives, with our own families, with our own communities, it turns out that your typical blue-collar worker can't take those things for granted at all. And when you take those things away that you were never really measuring in the first place, in measures like GDP, and lower consumer prices a little bit, and say, well, ta-da, according to our economic measures, you're better off than you were, In fact, you've done a great injustice at the end of the day to them. And that is exactly what we've done with our model of globalization, I would say, over the last few decades. It is something we are thankfully beginning to unwind, but we have a long way to go.
Thank you, Oren. Bryan, would you like to lay out your case?
Sure thing. Thanks, Ian. Thanks for this great event that FreeOp is hosting. Thanks for your comments, Oren. Just a little bit of background. I hit the jackpot this morning coming over here on my Uber. I got BMW X3, and nothing against the Honda Civics or Toyota Camrys and Celicas. It was a pretty nice ride. It was also a car built in South Carolina. And I hear people say we don't make anything in the United States anymore. And I was in a car made in the United States, so I'm not really sure what they're talking about. And if I could focus on BMW just for a moment, it's an aside, I didn't have it planned, I'm sorry. But the biggest car exporting state in the United States is South Carolina. I don't know if anybody here is from South Carolina or from Alabama, because I think Alabama is probably about to overtake South Carolina. Now, are those workers at that foreign-owned plant funded by foreign investment worse off, those blue-collar auto workers, because of foreign investment in the United States? And those auto factories, which around the country make half of U.S. vehicles, roughly? So that's just the rhetorical question that I wanted to throw out to start out with. My planned remarks were to give you a little bit of background on myself. Bryan Riley, grew up in Manhattan, Kansas, the hinterland, as Oren calls it. I'm a little bit older than most of you in this room, so I was thinking I had a chance to vote, for example, for President Reagan in the biggest landslide, electoral landslide in my history, biggest U.S. landslide since 1936 or so. I wound up working in D.C. and advocating for trade when NAFTA was passed, when the World Trade Organization was created. And we can look back now, if you look at the World Bank data on U.S. manufacturing output, real output adjusted for inflation is 60% higher than it was right before we passed those agreements. If you go to the Congressional Budget Office and look at the lowest income households, the poorest 20% of households, their inflation-adjusted income is up 45% since that time, actually 55% if you include government transfers. So I think there is an important and a positive role that I believe. I guess I'm here to defend that track record and to encourage more of it. I wound up working at the Heritage Foundation for a few years, which you all are familiar with, went to NTU, National Taxpayers Union, which to their credit, about 6 years ago started the Free Trade Initiative. They viewed the potential trade war and imposition of import taxes as the biggest threat to taxes. So that's a little bit how I got here today. And you probably are wondering, what in the world is Bryan talking about voting for Reagan over Mondale and having that opportunity? And the reason I bring that up is I will talk to people sometimes about economics policy, about trade policy, what have you, and I'll say, well, Reagan did this, and Reagan did that, and these were great ideas. And very often they'll come back to me and say, Bryan, how old are you? That was a long time ago. Nobody cares about Ronald Reagan anymore. That stuff doesn't work. We need a new conservatism. And I would just like to read a couple of quotes that I think, what I hope will illustrate where I'm coming from two different sources. The first is, our trade deficit is a looming disaster for the national economy. The second, America's enormous trade deficits are a double disaster for the nation. One of those, or I know you'll recognize, is from American Compass. One is from the presidential platform of Walter Mondale, the biggest loser in presidential elections since 1936. So I can respect the idea that, hey, Ronald Reagan, that was a long time ago, we need to do something different. But the idea that we're going to have base our policies on trade deficit theories from candidate Mondale, that we're going to have the domestic content requirements proposed by Mondale, that we're going to have tariff policies proposed by Democratic Congressman Dick Gephardt, that we're going to have China trade policies proposed by Bernie Sanders. Now, doesn't mean those are necessarily bad. That's another topic. But to say these are new conservative policies, I don't think they're new, and in my opinion, they're not conservative. And it's not the direction that we want to go in the United States. So I'm going to say just a word about economic policy, in my opinion, and national security issues. We've heard a lot of talk about China, and Oren mentioned economists. Most of you probably know this, but 95% of American economists say that tariffs and quotas reduce overall economic welfare. So we're not talking about a couple of ivory tower guys at this institution over here. It is as close to universal as you can find. Now, it doesn't mean they're all right. Maybe they're all wrong. But this is just something that I wanted to share with you. The other thing I wanted to mention that is so different than when I started working on trade policy. So we're talking about NAFTA. And the fear was, where's going to be a giant sucking sound? Nobody's going to invest in the United States anymore. No, why would they invest in the high-wage United States? And now that argument has been turned and flipped on and reversed. The problem is we have too much foreign investment in our economy. So if you look at total trade and investment flows, for example, they all balance. And the concern I think that many people have, and if I understood Oren correctly, the concern is that we don't trade goods on a dollar-for-dollar basis. People in other countries take some of those dollars and invest in our economy, which I would argue, if you're a BMW worker in South Carolina, is not such a bad thing. I would argue that if you are a federal government running $2 trillion deficits a year and you've got to finance it somehow, we shouldn't have those deficits, but the ability to attract foreign investment is a good thing. And I think the reason that we have those investment dollars coming to the United States is because we're the best place in the world to invest, right? That's why people want to invest here. We get those investment dollars because of the big budget deficits run by the federal government. You want to do something about that, stop running budget deficits. Don't start taxing capital inflows as some people want to. So I have, Oren, you can correct me if I'm wrong with this, but I'm not concerned about foreign investment. I think investment is good. I don't care if it comes from Germany or Japan or Kansas or wherever the case may be. So that's my view on that. With respect to national security, I was reminded, and I always have to remind myself, because I've given the economics spiel, that after World War II, the reason that the United States started the General Agreement on Tariffs and Trade and started all these multilateral agreements and moved to reduce trade barriers was not for all the things that I think are great, and that you described, that typical economist thing, free exchange, lower tariffs are good, more economic growth. It was to combat the Soviet Union and to have more trade among our allies and to keep countries from getting pulled into their orbit. So I absolutely agree 100% with you, Oren, about concern about China. But what I don't understand is if national security is important, economic security is important, why are we putting national, I'm not talking about you in specific, but why China's a concern, we're worried about national security, we got to do something about it, so we're going to put steel and aluminum tariffs on Israel. I don't understand that. I don't understand why Biden hasn't taken those tariffs away, by the way. Instead, he's threatening to put new national security tariffs on Europe if they don't comply with what the U.S. wants them to do on carbon tariffs and things like that. So to me, one of the best ways to deal with China, and certainly historically I think it worked well after World War II, was to strengthen our allies diplomatically, economically. People want to be friends with the United States. They don't want to get, countries don't want to get pulled into China's orbit, so let's give them a positive alternative. Let me wrap it up there, Ian, and see if you and the audience have some thoughts.
Excellent, thank you, Bryan. Oren, would you like to respond? Take a couple of minutes to respond to some of Brian's points?
Yeah, I guess I would focus on 2 points. One is it's very interesting to bring up the extraordinary strength of the auto industry in the American South and the investment that's occurred there. The history of that, of course, is that Ronald Reagan imposed an extraordinarily aggressive trade barrier. When Ronald Reagan took office in 1981, he negotiated an outright quota on imports of Japanese vehicles because the Japanese were eating Detroit's lunch. Not a tariff, not some sort of just absolute, you may not import more cars than you did in prior years. Now, economists, you will be unsurprised to hear, you may have just been an early voter at the time. I suspect you would have been vocally opposed to this, said this is a disaster. We're interfering with free trade. The result was that the Japanese moved their production to the American South. The entire development of the industry in the South, which then brought German automakers as well, began with Japanese assembly plants, which came only because of the trade barrier, and were then followed by entire supply chains. And now even Japanese R&D is done in the US. Now the quotas only had to remain in place for a few years. Once the investment had started in the US, of course, it turned out that this was a very sensible place to manufacture things. We've seen tens of billions of dollars in capital investment, hundreds of thousands of jobs, and the BMW that you got to ride in today. That is all the product, not of free trade, but of extremely interventionist trade barriers by the very great Ronald Reagan shortly before you proudly voted for him in 1984. So that's one point I would make. The second is with respect to this word investment. I think it's very important to recognize what we mean by investment, and Bryan, I think, sort of helpfully noticed this when he blurred the case of actual foreign direct investment building things in the US, let's say an auto plant in South Carolina, with financing our $2 trillion deficit. Now, both of these things count as investment in the general ledger, but I think that anybody with really a modicum of common sense can see that while obviously the Japanese building a Toyota plant in the United States has significant economic value, us sending a piece of paper to the Japanese that says, thank you for sending us stuff, we will pay you sometime later, does not have the same economic value. Those both count as the same investment. And do you know what share of foreign direct investment is actual greenfield, new investment building things in the US?
About 5%, I think.
5%. Last time a couple years ago was 2%. I'll take 5%. Virtually none of it, virtually all of the, quote, investment that we are attracting into the United States, thanks to our massive trade deficit, does not build anything in the United States, okay? It is equity. Half of all US traded equity is now owned by foreigners. It is corporate debt, it is treasury debt, it is an IOU saying we will pay you back later. And so let's just be very clear when we use this word trade, what the trade is. Other countries send us stuff. We send back pieces of paper saying, thank you very much for the stuff. At some point in the future, somebody else will give you either payments on that debt or you will benefit from ownership of more of our economy. Okay, that is the trade. It is not a good trade, and it is not investment in the sense we actually mean it when we're claiming that we're strengthening the American economy.
Oren, you've only mentioned the T word once, tariffs. Can you explain your position on tariffs and what is a tariff for?
Sure. So if we're talking about, if we feel like we have a problem here, what do we do about it? At the end of the day, it seems to me the problem is that producing things in America versus abroad has significant value. That policy that by default, the private sector is not going to recognize. You as a consumer don't individually take that into account. One way to look at it is it's a form of externality. And so if we have a preference for relatively more domestic consumption, at least to the point where we've balanced our trade, a tariff is one of the most effective ways of actually reflecting that in the prices that people face. And so it seems to me that what we want to do, as was in fact the tradition in US history, it's very funny to cite protectionism as a Mondale policy. This was, of course, the policy of Alexander Hamilton, Abraham Lincoln, Theodore Roosevelt. It was a policy of most American policymakers, certainly Republicans, up until quite recently. A tariff is a very helpful way to put a thumb on the scale for domestic manufacturing, to ensure that we actually create more incentives for the real investment in actually building things in this country that will address some of these imbalances.
Bryan, did you have anything to say on what tariffs are and what they're for?
Well, sure. The idea of putting the thumb on the scale for manufacturing, if you look, and I think talk to any manufacturing companies and owners around the country, I'll note that for all but one of the last 10 years, U.S. manufacturing employment has been increasing. And for manufacturers, their main concern is, how do I get good employees? How do we have a good regulatory environment? How do we have a good tax environment? So those are the things we need to do. Politicians, often, it's easier to blame some foreign country for the problems and then address some of the concerns that originate here in the United States. You talk to a lot of manufacturers, unless maybe they're steel producers, they're going to say, look, I rely on imported parts. A lot of the things we make in the United States are imported parts. You buy a Ford F-150, so that's an American company, American workers. It's not the foreign investment that some people are concerned about. Half the value is from imported parts. Some people want to put domestic content requirements on cars. Again, this is an old 1980s policy. In USMCA, there's a 75% threshold. You go to Ford, GM, or Dodge, or whoever, and say, your cars, to protect and promote jobs in the United States, have to have a 75% domestic content. That doesn't help blue-collar workers. It doesn't help the blue-collar workers who buy pickup trucks. It doesn't help the blue-collar workers who assemble pickup trucks. And those quotas that Oren mentioned, I would point out that the reason President Reagan imposed those is Congress was about to have even more strict barriers, and it was merely a way to prevent Congress from doing something even worse. BMW didn't come here because we had quotas, because we never had quotas on European cars. Same for Mercedes, same for Volkswagen, same for Audi. So sure, that initially probably did encourage some Japanese auto investment, but they kept coming here because it's in their interest and because it makes economic sense, not because of some government intervention in the economy. One last thing I want to add about blue-collar workers. We have, when we impose tariffs in the United States, the International Trade Commission looks at unfair trade practices. I would like to see the law changed, Ian, so that when let's say the fertilizer industry says we want tariffs, I would like the International Trade Commission to be able to look at what will the impact of those fertilizer tariffs be on American farmers? What will they be on American food consumers? Steel industry comes around again wanting more tariffs. I would like to see the International Trade Commission either required or at least have the authority to consider what are those tariffs going to do for the economy as a whole. Right now, they can't do that under U.S. law. I say, well, we can look at, is this going to help or hurt the steel industry? Well, what about those auto workers? What about the farmers buying steel and aluminum-made equipment? I would like to see us account for the interests of blue-collar workers explicitly. Right now, we don't do that.
Yes, I think Henry Hazlitt would very definitely agree with you on that. I'd like to open. I've got tons of questions, but I'd love to open this up to the floor. Can we get some questions? Dalibor. Yes.
Yep. Thank you. So this is a really fascinating conversation. There are so many different threads to pull, but
Sorry, can you introduce
yourself? My name is Dalibor Rohak. I'm a researcher at the American Enterprise Institute. So I have a question for Bryan, actually, on this question of foreign investment and on how you see it through fairly sort of benign set of lenses. So money flowing in, financing our fiscal problems. But what would you tell to somebody who would say that the sole fact that the United States has been enjoying this exorbitant privilege by being having the world's reserve currency has in fact dulled our ability to make difficult fiscal choices? That it was partly because there is this sort of steady inflow of foreign investment going into securities of various sorts that our Congress right now seems to be unable to make any decisions about fiscal policy, taxation, balancing budgets over the long term. And if you sort of see that as a problem, how would you address that through trade or non-trade means?
You have described, in my opinion, the situation accurately. We have the world's reserve currency. We are the country that everybody wants to invest in. We can borrow $2 trillion a year currently because everybody wants to save U.S. investments. That's a good thing for the economy. Now, does it enable us to do policies that we shouldn't? We should have closer to a balanced budget, in my opinion, if not a balanced budget. We can get away with not doing that because of foreign investment. To me, the idea is do what is in our best interests and let the investment come if we're the best place in the world to send those dollars, not to say, well, things could get bad in the future. And what if the 15 or 20% of our stock market that is owned by foreign investors, what if they decide they want to pull out? Well, how about if instead we adopt the kinds of measures that encourage more of that investment and remain the country that everybody wants to do business in? I don't know that I'm directly...
You're sort of like assuming the solution to exist, right?
I'm not
like,
assuming a solution.
because there is a political economy problem involved in this. That like as long as this federal government has access to this sort of steady stream of cash from abroad, it's never going to get itself more disciplined and lean. You say we should have somewhat of more of a balanced budget. I agree with that. The question is, how do you make that happen?
But see, I don't see that as an assumption. I see it as a policy recommendation. Continue to be the best place in the world to do business, and we won't have to worry about any of those. Now, if things go down the tube, that's a different story. The one benefit might be it would reduce our trade deficit. For people who are concerned about trade deficit, we know how to reduce trade deficits. We have a great recession, or even where the trade deficit goes down by 40%, or we have trade surpluses like we did during the Great Depression. So we know how to reduce the trade deficit if that's our goal. I just hope that's not our goal, and we continue to be the leader in the world and take what comes with that.
Yeah, I actually never thought of it this way before. This is actually very helpful. I would suggest instead of using the word invest in these conversations, we use the word make a claim on our future resources. Because when you say invest, right, what we're picturing in our head is, oh, this is like incredible. Someone's building something in America. That is not what we're talking about when Bryan says invest. Right? What the reason that everyone is, quote, investing in America is not because they are building things in America. It is because they see a claim on future American resources as more valuable and reliable than a claim on the future resource of other countries. Now, all things equal, that I'm glad they feel that way about America. It is true that America, relative to a lot of places, is stable. Probably more importantly, it is true that America, with the dollar as the reserve currency, is seen as the desirable asset in which to hold your savings and investments. But we should stop using this word invest to suggest that what's happening is people are sending their money to America because they really think America's a great place to do business. When you buy an American Treasury bond and that finances unfunded entitlement payments that go directly to consumption of foreign goods, you are not doing business in America or investing in America in any meaningful way. You are simply saying, we would like to send you our produce of today for future claims on your economy tomorrow. And we prefer future claims on your economy to future claims on other economies. I guess that's great, but that does nothing for American workers. So let's I'm guessing Bryan's not going to stop using the word invest, but let's use in our heads every time we hear the word invest, let's remember that no actual dollars are flowing into productive activity in America. It is simply goods produced elsewhere into America in return for a claim on America's future productive resources.
John Hood. I'm so glad that you just brought that up, Oren. This is what was puzzling me earlier about the conversation. First of all, I'm very happy that in a conversation about trade and free trade and trade deficits, we're spending so much time on the flip side, which is the capital account surplus, which by definition you have to have if you have a trade deficit and vice versa. So if we're talking about investment, I genuinely would like to understand, because what you just said, I'm having a hard time wrapping my head around. Obviously, if a foreigner buys a treasury bond, now there is some investment the federal government does. The federal government invests in various kinds of assets, military and domestic and transportation. That's a genuine investment. And in theory, if you had an almost balanced budget, the way Bryan was talking about, you'd still borrow some money for long-term capital assets, and I assume you would grant that that would be actual investment. Similarly, when you're lending money to companies or buying stake in equities of companies, what do they do with the money? I mean, it's not just a claim on their future income. It is a claim on their future income. The reason why they're willing to give up a claim on their future income is because they can take that money and use it for something. And presumably that they might be manufacturers or retailers or service industry, but they use it to produce goods and services. So literally, it is obviously investment by any definition I've ever heard of. Help me understand how it is not. Because if you're, set aside the federal government, I'm talking about other kinds of securities. By definition, I'm giving a capital to you or whoever. That company is going to do something with it to produce income that I have a claim on.
Right.
What is that if it is not investment?
So when you buy stock in IBM, who gets that money?
You want me to name them, or
who gets the money when you buy stock in IBM? You were just telling a story, so let's continue with the story.
well, the value. Sometimes companies finance investment with equity. Sometimes they invest it with debt. There's a combination of the two in most cases. Not sure. Again, I quite follow what you mean. They obviously don't put it in the underground or something.
No,
They
in fact,
use
you're
it
not
to
buying the
produce-
stock from IBM at all. You're buying stock on a secondary market. So again, what we call investment when you buy stock on an American stock exchange is not money to the company whose stock it is. It is a secondary transaction from whoever else already owns the stock.
Unless they're issuing new stock.
Unless they are. Fortunately, we have a lot of very good empirical data on what the U.S. corporate sector is doing, and it is not issuing stock. It is conducting more than $1 trillion a year of stock buybacks. And in fact, if you look across the corporate sector as a whole, we've done a lot of research on this at American Compass. What you find is that the corporate sector is increasingly returning cash to shareholders much more quickly than it is raising money from financial markets at a much higher level than it used to. So we have, for the last decade, until the year or two of inflation we've just had, we've had interest rates of roughly 0%, right? Capital has been virtually free. We have had corporations disgorging massive amounts of cash back into financial markets much faster than they try to raise it from financial markets. And as we were just discussing, when you look at where FDI goes, maybe 5% of it actually goes to greenfield investment in building anything. It is virtually all secondary market acquisitions. Now, the money ends up somewhere, right? Where does the money end up? Well, we know who the net borrower is in our economy. The net borrower in our economy is the federal government. And I entirely agree with Bryan that the budget deficit is a big part of this and something that we have to think about and figure out how to address. What I'm rejecting is just the empirical descriptive claim that the arrangement as it has been operating is a good one for the American economy or the American worker. And so to assess that, we just need to evaluate the flows that have actually occurred. And the flows that have occurred are not foreign capital actually reaching companies that otherwise would not have had access to cheap capital. The flow that we have seen is virtually entirely cash going into financing government deficits, with no evidence, in fact, that there's been any change in the cost of capital for major corporations, or for that matter, that major corporations even use their cost of capital in determining what investments to make. They have hurdle rates 8-10% above their cost of capital, and that's what drives their disgorgement of cash back into financial markets. So I'm all for actual investment. My concern is that the model of the economy that we have been running in this country for the past few decades looks nothing like that, and imbalanced trade with a massive capital account surplus is not driving it.
Thank you. I want to make sure, we've only got a few minutes left. I want to make sure that 3 people get a chance to ask a question. So I'm going to ask you to be brief in your question and brief in your answer.
Hi, I'm Candace Perucci. I'm in the Utah House of Representatives. This panel, we were talking about also blue collar Americans and its impact on it, right? And this summer, the song "Richmond North of Richmond" became an anthem for, I would say, middle class America, blue collar Americans especially. Both my brothers work in construction. They feel like college is an ivory tower they don't need to go to, and they feel left behind by America's institutions and our politicians. What is the message as conservatives to blue collar America that a lot of us find ourselves in, on why our system should work and what policies we should be implementing to actually help the little guy?
I'll say something about this, but I'll hand this one over to you. In terms of what the political message on TV is, I'll leave that to others. In terms of the substantive message, what we should be focusing on is productivity. Growing productivity for the typical worker is the recipe for long-term rising wages, rising prosperity. It has historically been the secret sauce of capitalism. It has not been happening in the construction industry for 50 years. Productivity in the construction industry has been declining for 50 years. It has not been happening in the manufacturing industry. When Bryan notes that employment in the manufacturing industry has been rising, in part that's because productivity in the manufacturing industry has been declining in the US for a decade. You need more workers in American factories today to produce the same output as what American workers would have produced a decade ago. That is a shocking failure of capitalism. It should not be possible, and is what you get in an economic system where you are not driving real investment into taking the blue-collar workers you have in this country and making their success necessary to the success of the business enterprise. And when we're thinking about these trade issues, I think we always have to think about them through that lens.
So real quickly, you mentioned the construction worker. I would say to the construction worker, you shouldn't have to pay tariffs on lumber that increase the cost of houses by $18,000 a year. You shouldn't have to pay 25% tariffs on imported steel that drives up the price of domestic steel as well. You shouldn't have to pay 10% tariffs on imported aluminum. If your spouse has a newborn infant and you want to get formula, and you can't find any at the store because there's a domestic shortage, then instead of having to figure out on Google or YouTube how to brew baby formula in your sink, you ought to be able to buy it from the biggest exporter and producer in the world, Europe, which you can't do today. It's illegal. So get rid of those barriers.
Thanks, Ian. Oren, question about tariffs. So you had this interesting piece in the Wall Street Journal the other day about tariffs, the case for tariffs. In the Trump administration, they raised tariffs, and the trade deficit went up, not down. So just what are your thoughts about that, about the trade deficit going up under Trump rather than down? And then the next question is, would America be better off if imports were zero and exports were zero, and therefore the trade deficit were zero?
So I think the Trump tariffs are an interesting case because it's important to understand that there were these limited sort of steel Section 232 targeted, tariffs on certain industries. By and large, when we're talking about Trump tariffs, we're talking about tariffs on China. And tariffs targeted at a specific country, you should expect to have the effect of shifting production for your market out of that country, but not necessarily reducing your trade deficit with the world as a whole. And that's exactly what the Trump tariffs did. Actually, the Peterson Institute has published some very useful charts that show if you compare imports from China of stuff that we put a lot of tariffs on, a little tariffs on, no tariffs on, you see a massive decline where the tariffs are largest. So tariffs do what they're supposed to do. What I would say about the Trump tariffs is as an element in figuring out what to do about this economic relationship with China and becoming less dependent on China, they had a significant effect. With respect to the trade deficit as a whole, I don't know anyone, at least I would not have said, yes, that model is going to do something about the trade deficit as a whole. With respect to what the optimal level of trade is, I think it's a great question, and I always sort of sequence my preferences in this order. Ideal would be high levels of trade that is balanced, and that's why I said in my opening remarks, I am all for free trade if it is actually free and it is actually trade. If you're telling me we cannot have that world because the rest of the world is doing a set of remarkable things that we have allowed them to do without challenging it for a long time, and my choices are either high levels of trade that are highly imbalanced or very low levels of trade that are balanced, I would say that the very low level of trade that is balanced is preferable. And I would also say that that is not necessarily a stable equilibrium, because part of the reason that we have the imbalances that we have are because we have shown that we will not do anything about them. I think if you present to the rest of the world the choice of the U.S. is not going to tolerate this case we have right now any longer, we will go down to very low levels of trade if that's what it takes to get balanced, or we can have higher levels of balanced trade. I think it would be in everybody's interest to opt for higher levels of balanced trade. But I think that the only stable equilibrium for the global economy is a policy environment where those are the choices, and then we get as high as we can. We have to take this current option off the table.
Yeah, so I think we've also left out something.
Sorry, can you introduce yourself?
Yes, thank you. Daniel DiMartino, Manhattan Institute, and PhD candidate in economics at Columbia. We've left out the fact that tariffs imply it's a political decision that will have political consequences in other countries. And so it's not true that, for example, as you propose, we can impose a 10% tariff in the world and nothing else is going to happen.
I didn't say that.
I didn't say you did, but that's your proposal. And the reality is that other countries would impose massive tariffs on the United States, will violate a host of international agreements, and it would reduce American welfare consumption of workers. So if our trade deficit is driven by budget deficits because we're a net borrower, a huge net borrower, and somebody has to cover that, and you want to close the trade deficit by increasing tariffs in perpetuity until we do, what you're really saying is that you think foreigners shouldn't buy treasuries and you want Americans to stop consuming and save more. So do you think it would be positive for that to happen, for other countries to impose tariffs, or trade deficit goes down, but as a consequence, Americans are forced to save a ton more of their income and really reduce their consumption massively?
Well, I guess I would say two things about that. First of all, I appreciate the point about the tariffs and other countries responding with tariffs. I think that's certainly likely to happen. I do enjoy the argument from economists that tariffs don't have any effect and just hurt you for imposing them. But also, if you do it, everyone else is going to do it too, right? These don't seem like entirely consistent arguments. I think it's safe to say that because, in fact, tariffs are effective, other countries are likely to retaliate. And so I would say two things. One, in the short run, that's fine. I prefer that world to the one we live in today. And to your point about that require higher saving, and apparently, to use our favorite word, investment, here in the US by Americans in support of producing things domestically, I think that will absolutely be in our long-run interest. I also think that the long-run equilibrium we're likely to move toward is one where all sides agree actually we could do better with more genuinely free trade. But if you're asking me to choose between the status quo and one in which we have lower trade and have to do more saving domestically and more production domestically, I would absolutely prefer that. And the last thing I would just add, and I think this goes to a lot of these discussions, is that it's very frustrating to me that a lot of conservatives who have done such a good job in other economic debates encouraging people to think dynamically rather than statically. So take tax debates, right, where we've said you can't just look at, well, if you lower the tax rate, people will pay less taxes. You have to think, well, okay, but let's play this down the road a step. What's actually going to happen? That is a very important habit of thought. And yet when we get to the trade debate, say, oh, we're going to impose a tariff, we just say, oh, well, consumers would pay X amount more, like set our hair on fire. We would have to save more. That's a disaster. Without actually thinking about, well, wait a minute, what would it mean for our economic trajectory in the long run if actual productive investment, reshoring of supply chains, investments in increased productivity of domestic workers were in the interest of companies? In a sense, I would argue it is a very powerful supply side policy. And I think if we think about it in those terms, we start to recognize that these sort of day one false choices are exactly the short-sightedness that conservatives are usually very good at pushing past into asking what is the shape of the economy we actually want to have, and what is the set of public policies that is going to move us in that direction.
Okay. We're well over time, but Bryan, if you've got 30 seconds to sum up.
I've got 15 seconds. This is not a theoretical question. We know what happened over the last 5 years. The U.S. put tariffs on other countries. Every single country retaliated against us. If you're a farmer, if you're a rancher, you became dependent on government handouts. If we go down this road again, you forget about any export markets. You're going to be reliant on the federal government. Again, that's not speculation. That's what happened. China didn't change any of its policies. The trade deficit with China went down. Our overall trade deficit went up. China's policies probably are worse now. Not probably, they are worse now than when the trade war started. However, Americans, not just the consumers when we go in to buy our affordable jeans and shoes, but American manufacturers and producers who rely on imported inputs, they're worse off because we know they had to pay higher prices as well. So again, I think that's the factual record of the last 5 years and why we don't want to repeat it as Americans.
Well, thank you very much, Oren. Thank you very much, Bryan. Can you give us a round of applause? Thank you.